Happy Friday, everyone. Jason Jacoby here with your closing bell for the week. We are back at it after taking a hiatus last week in terms of the videos. Hopefully you all had a wonderful Easter with your friends and family. I know we did. We all got together, had great food. My family and I went to church, hunted for eggs. It was a wonderful weekend. So lots to cover. Again, you can read more about it in detail below in the newsletter, but I want to get you some main information in this video and paint some broad strokes on some main topics that I think you'll find important. And then again, that you can learn about more below. So first thing, let's talk about the Fed rate hikes that have gone into effect over this past year. 475 basis points, 4.75% in rate hikes this past year. That's insane, right? I briefly talked about it on our social media post from earlier last week, but the M2 money supply, how it was the largest injection of cash and liquidity into the system, over 40% increase in the M2 money supply. And then all of a sudden the Fed comes in, puts a kibosh on it, and we start to raise rates, tighten monetary policy, and try to slow down inflation and try to start getting into a disinflationary environment, which would get us closer to the 2% target range that the Fed would like us at. Now, dating back about 90 years, got to look at the inflation numbers. You look at year-over-year inflation since the late 1920s, early 1930s. The inflation rate year over year has been about 3.9%. Okay, so I talked about we were in an inflationary environment for about 50 years, and for the last 40, we've been about a disinflationary trend. So 3.9% year over year inflation rate, dating back to the late 20s, early 30s. Now, with that being said, I think 2%, and Boyer Financial, our opinion, is that 2% is pretty low. Do we think we're going to get back there in the near term? Probably not. But 3% is livable. Again, dating back to the late 20s, early 30s to the Great Depression, 3.9% year over year. And we've had great markets. We've had robust economies. We've had opportunities or low taxes in comparison to other world economic leaders and countries. So that is all okay in terms of the macro picture of inflation and what number we need to be at. So I think the Fed is a little too hell-bent on getting to that 2%. I think that maybe taking a slight pause here as we move forward to kind of get some more economic data and let the data define what we do. Obviously, our big want or wish in this case would be to open the supply side, because the more supply could cater to the increased demand, which is inflation, right? When you have a high demand that with a lower supply, that creates higher demand and spikes inflation and the cost of goods. So that would be our wish, would be to open the supply side of the economy so you don't have to dampen the demand side, which is what the Fed's trying to do by tightening the monetary policy. So that's what we'd like to see. So again, we're going to be watching these numbers, but they're trending in the right direction. That's a great thing. So stay tuned again in the next week's episodes coming up here, and in our newsletters, we'll be keeping you up to date, and via our social media channels, if anything that's breaking newsworthy. Next thing is, we talked about the labor force being the bastion of strength in the economy. Those are starting to show cracks. There's Best Buy just announced today that they're laying off thousands of employees. The unemployment claims, the initial jobless claims, came in at an estimated 239,000. Again, these get revised, but 239,000, which is above that 200,000 kind of psychological threshold. But by no means does that mean it is a dire workforce situation. That's not what it means. It just means we're trending and we're seeing cracks in the labor force participation rate and jobless claims and things of that nature that will really kind of be telling that last bastion of strength in the economy that's been holding up so well is starting to falter a little bit. So again, that's something to be seen. It's not doom and gloom. It's not, oh no, the world's ending. It's just, hey, the Fed's goal of tapering down inflation and kind of slowing down the economy is working, what they want to do. But again, we're walking the tightrope of not wanting to go too far to destroy the economy. We want to get inflation down so we can kind of have an economical reset and go about our days and our lives. Another thing is retail sales. That's another thing we talk about in our newsletter. Fell short of expectations with a loss of 1%, which is the largest figure since November of the previous year. So again, the economy is just slowing down. That's the name of the game at this point. Again, good news is bad news for the Fed, and bad news is good news for the Fed. So it's kind of like that weird seesaw of we like strong labor markets, but in terms of having that affect inflation and the Fed's decisions to raise rates, we don't like that. So that's when we say good news is bad news, and vice versa. So last thing I want to touch on is we're in earnings season, obviously, for Q1. Big banks reported today, JP Morgan among Citi and other ones. They all beat estimates. JP Morgan had the biggest stock price increase in over a year. And it's the big banks are doing well, obviously, as a byproduct of SVB collapse and a few other regional bank weakness. You saw a lot of outflows from the regional banks and go to the big banks. The government and I believe it was Larry Fink was on TV today. He was a BlackRock CEO, and regardless of how you feel about him, he said that the big banks are super healthy and strong. So I'm not taking his word for it, but that's just what it seems based off of the stress tests that these banks are put under each year. And in comparison to the types of stress tests that these regional banks, obviously that didn't really work out too well for them. But again, it seems like liquidity is there. A lot of the big banks have assets. They're positioned very well for the future. So that's a good thing. Again, this might not be the end of the small bank or regional bank, even mid-sized bank. I wouldn't say collapse, but downtrend for them, for that sector, as it's harder to loan out money. Again, loan officers are being told to put down their pens at this point, just with higher rates and just the reverberation of the Silicon Valley Bank collapse. They want to be more careful at this point. So that's what we're seeing. But again, great earnings reports for big banks. Again, earnings drive long-term stock price. Just keep that in mind. But that was the last thing I want to touch on in the video. If you have any questions, feel free to reach out to us. We're always here for you. But have a wonderful weekend.